Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this week's edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, two earnings calls that we dive deep into, including Five Below and GameStop, both of whom caught a lot of headlines this week. We'll also discuss an interesting report surrounding cold storage and what it means for retail in the U.S., that done by CBRE. A quick reminder to like us, rate us wherever you do access us, and also check us out on Instagram and Twitter at Retail Podcast. This week on Instagram, I put up some pictures from a retailer in Woodward, Oklahoma, actually embracing their old 1950s look, so that's worth checking out there, as well as repurpose of some old Safeway real estate, all that on our Instagram page. So we begin today's show as we go back to the dollar store segment this week. We went, of course, in-depth last week talking about Dollar Tree and Dollar General, but Five Below released earnings after the bell on Wednesday, June 5th. And it's one of our favorite retailers here. Zach's consensus estimates had the ever-expanding retailer coming in with 35 cents in adjusted earnings per share, which would have been slightly below last year's quarter, sat at 39 cents. There's already a lot of optimism baked into expectations for the company going forward. They have a 46 price-to-earnings ratio going into earnings, right there with one of our other favorite retailers in Ollie's Bargain Outlet. But we kind of use this earnings call to harken back to the doom and gloom articles a few years ago about Five Below's momentum ceasing there because fidget spinners were falling out of favor. But we realize looking at this call, analysts are wrong an awful lot. And in this case, this is one of the few scenarios where we were correct, thinking that Five Below would manage to capitalize on newer and better trends. Always one of the better merchandisers out there, Leighton, and Five Below, as a result, has continued their massive expansion efforts over the past year.
Yeah, it's really weird because in the city that I used to live in the Midwest, it's a fairly small metropolitan area, I think ranking 69th largest in the United States, but they just got a Five Below, and that store has been surging with traffic. So you talk about entering into new markets, expanding their store base. They are doing just that. They currently have over 800 stores in 36 states. Compare that to just 2 years ago at the same time when they had just opened their 555th store and their first California stores. And their new stores are doing very well. They chart success of openings by sales, and 12 of their stores opened in the spring ranked in their top 25 of all time for spring opening performance. With that, we move on to the call, and as was expected, net sales took a big jump, increasing 23.1% over last year, a function of all those new stores we talked about, but also a modest same-store sales increase. So those fidget spinners, like Trent said, it's not just about those. It's not just about the same selection they had just a couple of years ago. It's about trying to entice your customers with ever-growing new items to choose from. Those new stores, by the way, continue to have a payback period of less than a year, which is just absolutely amazing. You want to talk about rate of return on retail, they are absolutely killing it in terms of sales and in terms of those gross margins, which we'll get into. But sales at stores open at least 1 year increased 3.1%, which is a solid number. Not mind-blowing when compared to the sales increases at Dollar General and Dollar Tree, Walmart, Target, and others that have been reporting earnings. However, they did note on the call that in terms of category growth, the growth was steady across all merchandise worlds, as they call them. They call their sections worlds, so all the different sections such as toys, consumables, etc. Net income, meanwhile, did see an increase of 17.7%, although they noted operating income decreasing as a result of some accounting shifts. As a result of the bottom line increase, earnings per share arrived at 46 cents, beating analysts' expectations on the surface. However, this includes an 11 cent per share benefit from share-based accounting. Including this, their earnings came in right in line with the 35 cents expectation. As a result, shares remained fairly steady in after-hours trading on Wednesday. They also took the initiative to raise full-year guidance on the call. This is the one-two punch that everybody seems to love, especially in retail, as retail doesn't always get the best news coverage. But revenue and comp expectations remained roughly in line with their earlier forecast, with a 3% comp increase for the full year expected. The company now expects to open 145 to 150 new stores by the end of the fiscal year, putting them near the 1,000 store mark. Remember, the company has routinely said they see white space for over 2,000 stores easily in the United States. I don't think any of us expected them to get to 1,000 stores this quickly. Now, net income is expected to be around $175.9 to $179.9 million, leading to diluted income per share of $3.11 to $3.18. Previously, they had guided for around $6 million less in full-year net income and 11 cents per share on adjusted earnings per share.
And that's kind of odd because they increased their outlook, but a lot of analysts came out right after the earnings call basically saying, the forward outlook isn't all that great. It's not all that improved. They don't really have answers on tariffs, that type of thing. And as a result, you saw shares fairly steady even despite the earnings beat. But as is always the case with earnings calls, we were more interested in the main goals of the company heading forward. And of main concern on the call, especially early on the call, was the company's infrastructure build-out. This is something that also came up in the analyst Q&A. And because Five Below is so bullish in terms of the white space they see in the U.S., they want to build out their distribution network proactively to be able to support their potential runway, those 2,000 stores that Leighton mentioned. Of note, in the most recent quarter, they implemented a new distribution center in the southeastern United States, specifically the Atlanta metro this quarter. Additionally, a southwestern U.S. distribution center will join the network or is scheduled to join the network in 2020. They're still online there to open in 2020. And what's interesting is that most companies, when you hear them on a call talking about the supply chain, they focus on how their new DCs or distribution centers assist e-commerce, but Five Below was much more focused on the ability for their network to support brick and mortar. They have a very limited e-commerce presence, although one that is growing. And they do offer some e-commerce options, but mainly the talk on the call was about how these distribution centers can support further expansion in these areas of the U.S. Now, as far as analysts were concerned, of course, their main concern on the call in terms of the questions they were asking centered around tariffs, and we'll get to those in a second. However, on the surface, CEO Joel Anderson said they've been able to mitigate the tariff impacts on their bottom line to this point, and they noted they have about 15% exposure so far. One would guess, actually, that it would be far greater if you were to ask me about a year ago what Five Below's exposure to China looked like. I would say probably more in the 25% range in all honesty. So 15% exposure. They've been able to mitigate those tariff impacts, and they talked further about some of the future things they're going to do if tariffs continue to increase. Another question coming from analysts on the call was about the toy category. Analyst questions about toys on earnings calls have declined somewhat. It used to be that these questions were routinely asked of retailers like Target, like Walmart. It was very top of mind about a year ago in a post-Toys R Us world. One thing Anderson said is that the toy category, or the toy world for Five Below, is still doing well. Seemingly every earnings call, this is one of the interesting things, we've actually touched on this before, but seemingly every earnings call, they bring up slime. And slime, in case you were wondering, is still a strong product for the company. So everyone can breathe a sigh of relief now. I think Five Below is probably the only earnings calls in the history of earnings calls to mention slime multiple times in terms of product sales. But on a more serious note, they did say a couple of things that stood out, at least to me, regarding their toy world. First, they're attempting to carry more licensed toys, so not so much with the generics, but licensed toys with certain trends, with certain brands. You're looking at, of course, a big focus on the Marvel Universe, that type of thing. And that's something that we've discussed in the past with more established retailers like Target and Walmart really doubling down on their licensed toy selection. Now, second, Five Below said the proliferation of licensed toys in their stores, along with the new movie releases coming out in the second quarter, may serve to even out the typically unbalanced toy revenue across the year. Now, they mention a lot of the toy sales for the company come in the fourth quarter. So in this case, they're hoping that some of the licensed toys that they're starting to carry but also some of the movie releases, some of the things in pop culture are going to help to even out those toy sales, maybe boost the first or second quarter to where those categories are actually going to be drivers for them potentially, rather than basically categories of stagnation until they get to the fourth quarter, which is the big toy selling quarter. Specifically, they did mention strength from Avengers Endgame related products in the first quarter. And looking ahead, they noted an anticipated strong second quarter in terms of these mass appeal movie releases that are taking place that should have some carryover to their licensed toy lines, including Toy Story 4 and another Spider-Man iteration. All in all, a positive for the company here with the toy world when, as mentioned before, some analysts projected softness in toys because of dying trends, and they've managed to stay on top of it.
As we delve into those trends, it's important to see what areas are most important for the company. Tech, candy, and create were the three worlds that saw the most momentum for the company in the first quarter. They've noticed a direct impact from their influencer campaigns as well, as they have partnered with two major social media influencers to showcase Five Below products. And this is interesting, and honestly, this might be the best way to get a store's message across to a wide audience, especially their tween base, although they are also looking at increasing TV penetration by advertising in markets with a larger number of stores. This is pretty smart in our opinion, as people still do watch TV across all demographics. Gaming, by the way, was another huge trend they saw, although the gain for Five Below isn't necessarily in the games themselves, but game-adjacent products like collectibles. And we'll talk about that a little bit later on, but collectibles is basically the one category GameStop is seeing success with. And additionally, Five Below is trialing gaming headsets in some of their stores. Finally, unicorn was a big trend for this most recent quarter. If anybody was wondering out there, it surprised us. We figured the unicorn craze peaked with Starbucks' disgusting unicorn blended drink that was featured not too long ago. Now, let's wrap up by telling you about Five Below, a story there, and discussing experimentation. We've kind of buried the lead here, but because a number of headlines alluded to some of their different efforts across the store chain, we still have to mention that basically Five Below has no problem treating their entire base as sort of a petri dish, trying out a ton of different initiatives all at once. They're testing out a new front-end model in about 50 of their stores currently, and about 110 of their openings this year will have a redesigned front end. This experiment looks the most likely to catch on out of any of their new initiatives simply because it assists on several levels. First, it seems to have improved front-end throughput in the test stores by allowing the customers to take on a more active role in the checkout process. Second, it extends the number of impulse buys available in the front end. Third, it allows for better associate movement from behind the checkout area to the sales floor, allowing for easier customer interactions and potentially, at least from the perspective of someone that's worked in retail for a long time, reduce shrink. The next experiment doesn't really have a name yet because they are testing out two different ones called Just Wow or 10 Below, depending on the location. They are training the sale of merchandise at the $10 price point. As we discussed last week with Dollar Tree, the success of this program will hinge on their ability to widen the number of products they offer and enhance their SKUs. We mentioned Dollar Tree because in some of their stores, they're extending that price point to $2. In Five Below's case, this is about adding SKUs to the tech and room worlds. They mentioned on the call that those gaming headsets and digital cameras were really going to be priced above their minimum price point. Specifically, they're looking to offer these products in around 25 stores by the end of the second quarter, but Anderson says the response has been positive from the early tests. Finally, on a larger scale, they are experimenting with selling products at $5.25 or $5.55 that were previously sold for just $5. This is, the company indicates, a direct result of pressure from, you guessed it, tariffs and the impending future increases with potential new tariff trenches. And you see that in addition to the mentioning of China, Anderson talked on the call about potential tariffs for India, Mexico, that really haven't been mentioned in the past week, and really needing to prepare on an organizational level if those hit. And you see, Trent, as such, they've looked at selectively raising prices for products in the $1 to $4 level and pushing some of their $5 products upwards to, again, the aforementioned price levels. But when asked by an analyst on the call Boy, they didn't just test prices at $6. Anderson maintained how important the number 5 is for branding and that they wanted the increase to be in cents rather than dollars because they approached their business from the customers out. This was a not-so-veiled dig at Wall Street's seemingly never-ending insistence for retailers to increase price points. Ideally, they'd like to work with suppliers to keep costs down despite tariffs. However, Anderson mentioned that they have been able to work towards getting suppliers in other countries to really kind of negotiate in some circumstances. Also, there is hope that a number of their products will be excluded from these tranches. In all, Wall Street reaction to the call was mixed, and the share price up modestly at the beginning of trading on Thursday after the call, but ended down slightly thereafter. We see a retailer in Five Below that is continuing to grow at an almost unprecedented rate while still having an excellent balance sheet, at least for now, Trent. There really is no reason not to think that they can't reach the 2,000 store mark by around 2025.
We move on in the Retail Focus podcast as earlier this week, embattled retailer GameStop released earnings on Tuesday afternoon. Now, expectations were already low for the company on Wall Street. We've been bearish on the retailer for quite some time, just in terms of their concept, in terms of their way forward, but Zacks consensus estimates projected an adjusted loss per share of 2 cents per share versus last year's adjusted earnings of 38 cents per share. Now, it was a mixed earnings report with the company beating on earnings, actually pretty substantially beating on earnings, but they missed on revenue. However, their stock was pummeled in trading after the call. One news outlet said basically the company is in the midst of going down in flames. Now, this isn't hyperbole, as it went south over 28% in after-hours trading, and we'll talk about why here in a second. To call it an up-and-down year for GameStop's stock would be putting it lightly, as the ride has been crazier for shareholders than a created ride on Roller Coaster Tycoon. Get it? Gaming reference there. This is why we don't try to infuse personality into the show. Anyhow, highs of $16.79 for the share in the past year. This week, the stock hit not only a 52-week low, but a 5-year low as well. Even before the call on Tuesday, the stock was up slightly, around 4.7%, alluding to that roller coaster mechanism. However, where it's at now, you have to go back as far as 2002 to find the share price as low as what it dipped to this week. And a good chunk of GameStop's customer base wasn't even born in 2002. So that's how low the share price is right now. That's how bearish most people are on it. Now, as far as the call itself, GameStop, as we talked about, they missed expectations on revenue, coming in at $1.55 billion. FactSet estimates were quite a bit higher, expecting overall revenue at $1.64 billion. However, as significant as the revenue miss was, as I said, GameStop did beat substantially on earnings. Again, analysts expected a loss of 2 cents or 3 cents if you use FactSet estimates, but GameStop came through with positive earnings of 7 cents per share. That's remarkable considering the reduced revenue for the company, but in all, headlines focused on the revenue miss. It was a promising sign that the company was able to do a little bit more on less revenue. So they were able to be a little bit more profitable than was expected. And what's more, their earnings actually beat their own estimates. The company itself projected earnings to be flat to a loss of 5 cents per share. So they even beat their own expectations. But, and there is a large but here, all of this came against the backdrop of poor same-store sales metrics globally. Comps decreased double digits, 10.3% across the enterprise. That breaks down to 10.2% in the U.S. and 10.4% in international locations. And despite this larger than expected comp drop for the quarter, the company still guides for full year comps to come in down around 5 to 10%, projecting that they'll pick up or at least stop falling by so much in future quarters. Now, the company does a pretty good job of breaking down sales increases or decreases by category, and there's some pretty clear winners and losers for the first quarter. A lot more losers than winners, if you couldn't tell by the reduced revenue. But in particular, sales of new hardware or gaming systems basically took a 35% hit year over year. with the company blaming soft Xbox One and PS4 sales. And not only did the sales of new gaming systems fall, but so too did sales of pre-owned gaming systems by 20%, actually a little bit over 20%. Now, it's tough to tell if this is because consumers are holding out for the next big thing, or the more likely scenario, the market has just been simply saturated by the existing generation of consoles. And that's something that a lot of people have pointed to. Several analysts have pointed to that as well, saying basically there's not a market for those existing consoles anymore because people are either waiting or they already have the console that they want. Another particularly rough sign for GameStop is that digital sales were down 6.7%. They blamed weaker title launches quarter over quarter, and we do acknowledge that gaming retail is often dependent on new launches in major titles as well as new launches for the hardware systems. However, digital gaming sales have been a big focus of the company, something they've mentioned on several earnings calls, as a digital delivery mechanism is increasingly used for several platforms. And the fact that digital sales were down by this much, that is not a good sign. It's a sign that people are either going direct to the developers, they're choosing games that don't go through a third party like GameStop, or they're using a different retailer for those digital downloads.
Well, in the positives category, accessory sales went up slightly, less than a percentage point, driven by increased demand for controllers, believe it or not. The biggest winner from the first quarter was collectibles, which we had alluded to earlier with Five Below, which continues to be a strong category for GameStop. A lot of retailers are trying to really attach themselves to that trend. GameStop over the last 2 years, if you go into their store, you will notice that collectibles take up much more of the sales floor space. Collectibles has been another focus area for the retailer, and it really showed this quarter. Category sales were up 10.5% over last year. Unfortunately for GameStop, they're going to need several years of these kinds of increases to outweigh the softness in the other categories that Trent just mentioned, because total revenue from collectibles was just $157.3 million in the quarter. Compare that to net revenue. Collectibles makes up just over 10% of sales. So if you're really trying to rely on that to make up your overall revenue piece of the pie, it's not really working that well for them. So even with the increases in collectibles, it just makes a small dent in the losses from gaming systems and software sales. Speaking of those software sales, by the way, they were down 4.3%. Basically, these are sales of all games, and this too was blamed on weaker title launches versus last year. And we mentioned that the revenue miss grabbed headlines, but sharing the headlines was the announcement that GameStop will cease their quarterly dividend. And we were actually wondering when that would happen. Our friends over at the Motley Fool, or not our friends per se, but those in the podcast industry that talk about publicly traded companies, did mention a few months ago when this was actually going to take place, if ever. But the dividend halt is effective immediately. And this is something that we've actually been surprised that they haven't done sooner as well. As a company, they're in the midst of a massive overhaul. They call it GameStop Reboot, and are in need of capital to execute on some of their initiatives. And really, Trent, this is the correct allocation of capital, and we just wish it had happened a little bit sooner. Full disclosure, we are not shareholders in the company, but you look at the time of the call, their dividend was almost comically high, $1.52 per share, or at Tuesday's ending share price, nearly 15%, a 15% yield on a company that has not been doing that great over the past couple of years. This, we think, was likely the major factor in the share price falling by around 28% in after-hours trading on Tuesday. GameStop had a massive number of institutional investors prior to the announcement. As of the 13F filings on March 31st, institutional investors owned $833 million of the company's approximately $1.02 billion in market cap. And you see their market cap was slashed after the call on Tuesday. It was down around $600 million, or in that particular neighborhood. You see, that's a lot of value lost for those shareholders, both institutional and individual alike. However, we tend to think that this is probably best for the company's long-term health. And despite any rough effect on short-term share price, this is probably the proper allocation of capital. Dan DeMatteo, their executive chairman of the board, said in the release that additional capital, or about $157 million per year, will instead be funneled towards debt reduction and some of their retail initiatives. Regarding that debt, they have about $436 million outstanding on their 2021 unsecured notes. Paying this off would, of course, reduce interest expense in the short term, but also leave the company with more financial stability as they enter an unpredictable era. And you look at some of the comments on the call, Trent, CEO George Sherman said the company's urgency is off the chart as far as keeping SG&A in check and creating new revenue streams as the company transitions overall. Indeed, cost and efficiency was foremost on the call, and the company has hired a consultant firm to assist in some particular areas. Sherman said that GameStop reboot isn't solely just a cost-cutting initiative, but that cutting costs is a major part of the initiative, at least. That said, the company doesn't know specifics on where costs will be cut, other than just a handful of areas, and probably won't until the consulting firm finishes their work. As a result, most of the call was just leadership taking in generic terms about urgency. And in the short term, though, the company does want to declutter the stores. Collectibles is not a part of this decluttering, thank goodness, and as GameStop actually wants to add SKUs in that particular area. And anecdotally, if you go into those stores, you can see that collectibles really are making their way from the rear end of the store to the middle and front sections of the store. They said on the call that roughly 20% of their SKUs drive 80% of their business. This means that there is a lot of space to remove items in store and truly rethink how they are allocating Salesforce space, since they are stuck with a lot of their real estate for the long term, thanks to long-term lease agreements. Might as well figure out how best to use it. This brings up a valid question. If they've known about the ability to remove or replace SKUs without a meaningful impact on the bottom line, why haven't they done that thus far? But part of the SKU optimization program is focused on their business around the golden 20%. So at least that is the bright side, that they're recognizing that part of the store optimization program right now. And you see that they have plans in place to focus their merchandising around that 20% and also redouble their efforts to ensure proper stock levels for those items. In the meantime, they will be shifting in and out other products as they try to find those truly dynamic traffic-driving products. Specifically, they mentioned collectibles exclusive to GameStop as one opportunity area.
They also mentioned trialing some new experiential platforms in stores as an attempt to drive traffic. Again, kind of back to the future here, because GameStop, oftentimes, a lot of their stores had experiential aspects to them when they first kind of grew as a company. And again, they have the real estate, as Leighton said, might as well use it for something if you're going to be removing SKUs out of the store. And to that end, Sherman said on the call that he's told his team that they don't have a real estate problem, despite analyst sentiment otherwise, and despite our sentiment otherwise, that they have way too many leases in way too many places, but rather it's a merchandise allocation opportunity. And this opportunity, he feels, can be addressed with very little investment. Most will probably be tied to deleveraging on margins because of clearance activity and getting rid of those SKUs, and not necessarily CapEx. Now, one comment that rose eyebrows is their goal of continuing to drive hardware sales. Hardware sales is obviously a major component of their top-line revenue, but at the same time, we're at the end of the current console cycle, like we talked about. And as we mentioned earlier, there's a real possibility that the console market is saturated. And Sherman even admitted that they're at the end of the current cycle, but that they want to emphasize value in their hardware sales so as to drive traffic. This extends to accessories such as controllers as well. And I get the accessories front, but looking at value in hardware sales, if you already have a PS4, GameStop trying to sell you a PS4 at a lower price isn't going to make you buy another PS4. It might work for controllers, but again, hard to see where that benefit is going to come from, at least in the short term, from hardware. But kind of the long-term idea for GameStop is that if they emphasize hardware now, they'll be well-positioned for the next generation of consoles. When they do come out, people will think of them as maybe a leader in the space. But again, it might already be too late to make an impression on the public as far as being a leader in that space, because again, we're between console cycles and people aren't exactly heading to GameStop for consoles right now. And when you see a 35% decrease year over year in a category, it's really rare to see a retailer double down on it like GameStop is. Also strange is that Sherman said they're not looking to diversify beyond the gaming space. And when you think find new avenues to drive revenue, which is what they talked about all the time on this call, you usually think outside the core business model or doing something maybe in the services category, like what we've discussed with Office Depot or CVS. GameStop, though, is actually in the midst of divesting their outlying enterprises and some of their services division. Of course, they sold off their mobile sales division, cashed in on that, and they're in the middle of a sale for their Simply Mac operation. So the question is, where on earth does GameStop see opportunity within their current space? It's one thing to sell off divisions, use the cash to pay down debt, that type of thing. But where do you see opportunity in the gaming space? And if you see opportunity, why on earth haven't you been capitalizing on it for the last 3 years? And I realize this leadership group is a new leadership group, but we just didn't hear a whole lot different on the earnings call. Look, it's true that participation in gaming is increasing, and they went back to this time and again, Sherman did, especially on the call, but also increasing that direct-to-consumer model from developers. And if we take Fortnite as an example, a wildly popular game across multiple different age groups, it's a very little benefit to GameStop versus a platform-based game such as something like Call of Duty, because if we look at Fortnite, you don't need a trip to GameStop to be able to engage yourself in that. You might be able to get some maybe Fortnite adjacent things at GameStop, just like you're able to do at something like Five Below, but there's just not really a tangible direct benefit for some of these games. And Sherman says they occupy a sweet spot in the industry, and it's true. They are the industry leader in gaming first retail. But they've got to compete against others like Walmart and Target that sell the same type of games in their electronics section, as well as additional retailers like Best Buy, for example. And it's true that they're currently profitable. GameStop is currently profitable, but that sweet spot that they're supposedly in also produced a double-digit drop in same-store sales, which is a far larger drop than just simply selling more stuffed Pikachu dolls can make up for.
Overall, this is a company that we're not real confident on in going forward. And you see that they likely have too many stores, and many of their lower performing stores are in smaller markets. Lots of those long-term leases, as I mentioned as well. So if you don't have a real estate problem and there's an opportunity to simply carry different gaming merchandise, where is that? And can it make a meaningful difference before new hardware comes out? And finally, we circle back to the biggest question of them all. If there's an opportunity to optimize SKUs in the gaming space, why haven't they done that already? Because it, to this point, has just been all rhetoric. And the answer to the last one, unfortunately, might be that there isn't enough opportunity that the leadership group sees, and that is exactly why it hasn't been done to this point. Ultimately, they just need to end up praying for new consoles to come out as soon as possible. Well, Trent, usually I don't talk about myself much on the podcast, but I wanted to tell our listeners about this exciting new company that we are working with and that I am working with. Recently, I've been dealing with both pain in my knees and my ankles, and I've been feeling a little bit older as I get up there in age. And while looking for treatment options on the internet, I'm a huge MMA fan, I came across a stem cell facility located in Medellin, Colombia called BioAccelerator. BioAccelerator is the global leader in stem cell therapy. They offer the state-of-the-art medical facility that a lot of up-and-coming programs are trying to achieve, and the ability to treat patients with tens of millions of active adult stem cells in order to help them recover from injury and other major medical complications. BioAccelerator currently offers treatments for a variety of conditions ranging from orthopedic injury, spine and disc injury, chronic pain, and even severe autoimmune disease. BioAccelerator has something for you men and women out there who are looking to stay in the game and keep yourself looking young and feeling youthful. And that's exactly why I've reached out to BioAccelerator, asked them for their anti-aging and rejuvenation treatments. Overall, it is a great decision. I will be tracking my progress as I go through treatment with BioAccelerator and giving you, the audience, updates as I heal and overcome my knee and ankle injuries. And if you or someone you know suffers from the type of pain and complications due to major medical conditions, join the likes of UFC Hall of Famer Matt Hughes, Chael Sonnen, and Chuck Liddell and many others like myself and contact BioAccelerator today.
You can start your path to wellness and become what they call a Bio X man, which is what Leighton should soon be, or a Bio X woman today. And that's www.bioaccelerator.com/the-retail-focus-podcast. You got to put all of that in there and tell them Leighton sent you. That's BioAccelerator, bioaccelerator.com/the-retail-focus-podcast.
For our last story, we have an interesting study that came out this week by way of CBRE, which is one of the world's largest real estate services firms, who really has indicated that increased emphasis on digital grocery sales could have a domino effect on warehouse space. CBRE, for those who are not aware, is one of the leading commercial real estate companies in the United States. They not only have services within brokerage, but they also have a lending arm as well. Beyond this, however, they produce very thorough research reports and are really a great resource for some high-level looks at the retail industry, and we love anytime we can get a more insightful look inside of retail in the U.S. In this case, the report looks at the state of cold storage in the United States. And the general argument is that the increase in e-commerce fulfillment needs for grocers may cause a necessary increase in the number of cold storage warehouses in the United States. And if not, retailers may feel the crunch on their bottom line. And let's start with some of the background from this report. First, much of the outlook is actually based around the presumption that e-commerce grocery sales will increase to account for roughly 13% of total grocery sales in the United States over the next few years. Currently, that percentage is sitting fairly low. It's sitting at low levels right now, Trent. Depending on who you use for that specific data, we found anywhere from 2 to 5% of the overall grocery pie is based out of e-commerce sales. However, you should underscore that an outlook of 13% is on pretty much the optimistic side of projections, and some projection systems have only e-commerce grocery sales sitting around 3 or 4% by 2022. So the 13% projection again by 2022 is sourced from the Food Marketing Institute, a company that we've cited often on this podcast and our defunct Food Focus podcast, and Nielsen. So CBRE hasn't just pulled it out of thin air. They are using reputable companies that really a lot of companies rely on overall when trying to research certain topics. But because of the increase in e-commerce grocery sales and the need to fulfill orders as well as eliminate supply chain shortfalls, cold storage in the U.S. is expected to increase regardless. In fact, the Global Cold Chain Alliance predicts compound annual growth rate for owners and operators of temperature-controlled warehouses in the U.S. by around 4% through 2022. Therefore, there is an expected increase in cold storage market share versus the rest of the industrial sector. Currently, it is only pegged around 1 to 3%. The cold storage space is very much an oligopoly with 3 companies, Lineage, Americold, and USCS, accounting for around 70% of the total cold storage in the U.S. Part of this is because of industry regulations and a higher barrier to entry. Interested parties must work around the FDA's food-grade storage regulations as well as temperature minimums. And so you really have to factor in all of that regulation. Additionally, the facilities have a much higher cost of build-out than a typical warehouse space. If you think about the maintenance of it, can be certainly pricey. All of this adds up to an average warehouse age of around 34 years in the U.S. for cold storage facilities.
But this is retail focus, not warehouse focus. So how does all of this affect retail, or more importantly, how does retail affect cold storage? Well, currently, and I found this amazing, but 79% of cold storage capacity in the U.S. is outsourced by participants in the food sales chain. So this includes retailers, this includes restaurateurs, that type of thing, but also e-commerce retailers. So it's amazing. A lot of retailers don't actually control their own cold storage. Now, of course, it does depend from retailer to retailer, but part of this is due to the costs and regulations we mentioned earlier. Sometimes it's easier to outsource to an organization that's very intimately familiar with cold storage. And CBRE is estimating that cold storage demand will increase as a result of more direct-to-consumer and e-commerce grocery sales to require up to 100 million additional square feet of cold storage over the next 5 years. So that's where it kind of comes in for retailers, because those that are switching to more of an e-commerce model, or those who are offering more e-commerce options, especially in terms of fresh food, especially in terms of frozen food, they're going to need to find ways, if they're doing direct fulfillment rather than something like a click list platform, to store those materials. And what's interesting is CBRE points out that currently the main players in the cold storage space actually exist in ports or near port cities or entry cities, basically. You have California, Washington, Florida, Texas. Those are the 4 main cold storage states in the U.S. And granted, those are also some fairly large states as far as populations, but one thing they also have in common is they've got these massive ports. Pennsylvania also in the top 6. New Jersey also ranks in the top 10 overall, as does Oregon. So that's really what you're seeing. You're seeing this combination too, because California, Washington, Florida, and Texas, if you've heard any of our shows that focus a little bit more on produce retail, those are also big-time growers in the United States as well for produce. So, of course, it makes sense to have more cold storage in those areas. But what CBRE is saying is, because grocery stores are needing ways to get food to consumers quicker, especially if they've got e-commerce fulfillment centers on the docket, you're going to see cold storage space demand ratchet up with smaller landlocked metro areas. You look at a metro area in the middle of the country, something like Kansas City or St. Louis, a city along those lines where their state currently doesn't rank in the top among cold storage. There might be limited cold storage. If you're a regional retailer, someone along the lines of Hy-Vee, for example, and you were looking at opening up an e-commerce fulfillment center like what they've actually done in Des Moines, then you either have a couple of options. You can rent out very limited space, and because of that, rent costs are likely to be high. Of course, electric costs are going to be high on it, but rent costs in particular, because that space is so limited, is going to be high. You can farm it out, again, a higher cost because you've got the oligopoly conditions and you've got limited space in the U.S., or you can build a brand new facility, which would cost a lot of money in terms of the build out. And of course, there's all those factors that we've already talked about. So really, this is as much of a looking ahead as anything else, but colored in with some interesting details from this CBRE study. And something that we found interesting is that it's not going to be very easy for a lot of retailers to find cold storage in the future. A lot of it's going to go to the highest bidder. So does that put retailers like Kroger, like Walmart, in an advantageous position versus some of these local retailers? We talked about H-E-B a couple of weeks ago and some of their e-commerce initiatives and how they're not quite as bullish on it as some other retailers are. It kind of puts them behind the 8 ball a little bit because they might incur some of those increased costs. So all things to keep in mind as you start to see these e-commerce platforms build out, especially with fresh and frozen food.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
That brings us to the last segment of the Retail Focus podcast, a segment we call Looking Ahead, where each Leighton and I take a look at a story we're keeping an eye on for the next week, month, or year, and we begin with Leighton.
My looking ahead story has to do with volatility in the bookstore segment. Oftentimes we talk about Amazon Go and Amazon's other initiatives to maybe build out stores throughout the United States, either with groceries or bookstores. But, you know, Barnes & Noble, always a topic of conversation when we mention things like that. And Barnes & Noble in the news as being one of the last major bookstore retailers that has been doing, let's say, okay, at least sustaining their presence inside the United States across the last few years, among the likes of, you know, maybe Borders, who has filed bankruptcy, and many others along the way, especially bookstores maybe that have been staples in the mall retail space. But my looking ahead story has to do with a rumor that hit the Wall Street Journal. People on both sides of the equation, people on both sides, the Barnes & Noble side and Elliott Management, a hedge fund in the U.S., is looking potentially at taking the company private. So Elliott Management is looking to buy the company, again, allegedly, for around $6.50 a share in a deal that would give the business a value of around $476 million. This would include all of the debt on the books, which, by the way, is over $120 million as of the last quarter. But if you look, Trent, you really see that the company has been churning a profit as of late. Their last quarter, they made a net profit of around $66 million. But before that, they had some ups, they had some downs. They had a lot of controversy in the executive suite. And a lot of people were pointing to that as the main culprit for their business shortfalls as of late. And I think this is interesting because if you take this company private, a lot of people are going to be wondering, what are they going to do internally to reinvigorate the company and potentially allocate capital to some better uses? If the company is taken private, they can pay down that debt. They don't necessarily have to worry about what the public says about their company and how they're leading the company going forward. And I think that would be very healthy for them. The one positive thing that I do draw from Barnes & Noble is that they have a really positive presence in a number of exciting new retail areas. And I live out in Orange County now. Barnes & Noble, they are very strategic as to where they open new stores, and they are very careful to keep their current store base up to par with the other retailers that they are around, and that they have a really solid presence in a number of metropolitan areas that are seeing new retail development. So it always strikes me as interesting anytime I see a newer, exciting retail development, and Barnes & Noble ends up being an anchor. So people are still going in Barnes & Noble shops. They are still going in, especially to get their cup of coffee and to just sort of meander around like they could have back maybe a dozen years ago when Borders was huge. But I think overall, the company still is extremely valuable in terms of being a destination for both millennials and some people in the younger demographic as well, and could sustain for years to come. But I think it being taken private is a very interesting proposition and could, at least in the short term, make shareholders relatively happy, as shares were up over 30% on this rumor from the Wall Street Journal.
My looking ahead story has to do with the consistent mess that is Sears, or Transform Holdco, as it says now. But earlier this week, Transform Holdco agreed to acquire Sears Hometown, an outlet store, something that was in a looking ahead story a few weeks ago. They've now named a share price. It's $2.25 per share. Now, keep in mind, Eddie Lampert, basically the largest owner of Sears Hometown and outlet stores, so very little to potentially block this other than the board of directors. To that point, though, the board of directors has undergone some replacements as ESL Partners, which is, of course, the hedge fund that Eddie Lampert oversees, has replaced two directors on the board of Sears Hometown and outlet stores. A couple of different concerns here, because one is they were concerned, Eddie Lampert was at least, that Sears Hometown and outlet stores were going to continue to close locations like they had been warning about, despite the fact that a lot of these locations are franchised. But he was worried they were going to continue to close locations, also worried that a couple of the directors might try to block the sale. And so one of the interesting pieces of drama surrounding this is basically, where is this going? And will there be any legal action here? Likely not. Likely that the merger is going to go through. But one of the interesting caveats to this is that under the agreement, Sears Hometown can actually try to sell off the outlet stores and a few other brands to third parties. The price has to be at least $97.5 million, but it's odd that that's a caveat in there. Kind of makes you wonder whether or not Lampert actually wants those outlet stores. But again, we've talked about in the past why this would be advantageous for Sears if they are going to a smaller store format. It would perhaps be advantageous to maybe streamline everything, kind of rebrand everything as Sears kind of grows out of bankruptcy. So I'll be keeping an eye on it basically to see if there's any legal issues, because this is so convoluted here that honestly there's bound to be something that's going to crop up, and anything involving Eddie Lampert, let's face it, at this point is not going to be a simple process. Well, that'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent. and we'll be back with you 1 week from now after Leighton jaunts over to Columbia and back.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.